What's good, YouTube? Welcome back to the Brown Gent. No, this is not clickbait. I'm really going to show you how you can win 100% of the time. But before we get into that, just a quick reminder, nothing I say here is financial advice. So keep that in mind, because remember, I'm just a guy on YouTube. Any idiot can turn on a camera and start talking to you. So just keep that in mind, okay? So as we talk about investing, a lot of people on either crypto Twitter, stock twits, YouTube, they've kind of got it mixed up between investing and gambling. And I'm going to set the record straight right here. On my channel, we talk only about investing. If you want to go gamble, if you want to roll the dice, go somewhere else or come back for another video and maybe you've changed your mind. Today, we're talking about options trading, but we're talking about doing it right. And before we start doing that, right now, just pause what you're doing, pause the video, post in the comments below, tell me what your experience with options has been, positive or negative. I want to hear it all. One of the things you have to realize is that most option traders fail, and it's no surprise. This is set up to be a somewhat rigged system. And yeah, of course, people do win. They count on it. It's just like playing blackjack or roulette at the casino. Most will lose, some will win, and it's those winning stories that gets people to continue coming back. You can also go down the route of being like Zach Morris and friends and like sort of setting up your contracts to win. That only works if you have exit liquidity while you pump the price of your contract so you can get in, get your followers to sort of buy in after you and sell. Now, obviously, I don't recommend this, and I'm glad to see the SEC is taking action against Zach Morris and his friends who've been doing this. But just remember, the biggest edge that you have in investing is time. So why would you want to give that up? Literally, people are willing to give up time to sort of have the extra leverage. Now, before we get into sort of option contracts and how you can win with them, let's just cover the basics. So I know a lot of people are somewhat confused on how options works. You have to recognize that options are a sort of derivative contract, right? They're the contract that gives buyers of the contract the right to either buy or sell a security at a specific price point sometime in the future. To get those contracts, they have to pay what's called a premium. And just like you can exercise options to sort of, execute if you're in the money and you sort of win, basically, you can either exercise and get those shares or sell the shares, or you can trade the actual option to someone else and trade on that premium. So there's multiple ways to play options. Now, options are either called call and put. Call option means the buyer of the contract will have to buy the underlying asset at a predetermined price. A put option allows the buyer to sell that asset in the future. And remember, all contracts related to calls and puts are related to denominations of 100 shares. So let's go over the basic call strategy. If you're bullish or you think a specific stock or asset is going to go up, you would buy a call here. And what the call would allow you to do is if you don't have enough capital, it allows you to take leverage and take advantage of these rising prices. So they actually have a very good example here. So if you're a trader and you want to invest $5,000 in Apple, and when Apple is $165 a share, you can buy like 30 shares for about like a little less than $5,000. Now, if the price of the stock goes up 10% to $181.50, if we ignore all the other fees you'd have to pay, your portfolio will rise to $5,445, which is the 10% gain on those Apple shares you purchased. Now, instead, let's say you took those $5,000 and instead you bought call options with a strike price of $165 on Apple that expires about a month from now. It may cost you like $550 per contract. This way, you can still get 9 options for the same cost as those 30 shares. Now, in the same situation where the Apple stock goes to $181.50 at expiration, then you will have made a net return of $9,990, which is double the capital invested compared to the $495 that you made in the previous example. Obviously, it's the extra leverage here that's super enticing. People love these huge scores. It gives you that ability, like a lottery ticket, to sort of put in a smaller amount and win a big amount. And your losses are always limited to the premium that you've purchased. One of the other things was that in that example, it was looking at 181.50 at expiration. Well, the reason it was very clear cut on this was options also have what's called time decay. So as it gets closer to expiration, the value of the option will also diminish slightly. There's a specific Greek alphabet letter for that. So if you sort of made to 181.50 and you have even more time, think about it like speed running. Then the contract's worth even more because you got an extra window of time where that thing can go up even more. So there's a lot of potential here, and this is what's really enticing. Now, here's the thing, and here's why I don't like it. When you buy a call option, you need the price to go up in order to win. However, let's say instead you're selling a call option, then you don't care what happens. If the price goes up and the call gets executed, not only do you get that premium, which you get the moment that you sell that contract, but you also get that strike price that you selected for the stock, which obviously I don't have to tell you this, but it should be more than your average cost basis. Now, I should mention that you should only do this with shares that you own. This is called selling covered calls. Now, the same thing happens when you sell a put option. You agree to buy shares when the price of a stock is below the strike price of your contract. Instead of just buying shares of a company, you can just sell puts, and if the stock price goes up, you just get the premium for free. Now, you will have to tie up some cash to buy 100 shares at the strike price for each put that you sold, but it's an easy way to make some good cash. And if the stock price goes down, you buy the stock, and this is why I would only do that with companies that I believe in. Companies like Apple or Tesla, where I would be happy to pick up shares at an even cheaper price. This is why I tend to sell puts versus buying shares outright. It's just extra money. Now, let's just say you've seen some good price movement on your premiums and you want to lock up that win. Well, you can buy those contracts back at a reduced price and get started all over again. So that's just it. It's a very basic strategy, but one I think that if you're an options trader, instead of being the person who's gambling, going to the casino, you can be the person selling the lottery tickets. And by doing that, you always win. Most of the time, contracts will expire worthless. And if you're the contract seller, this is exactly what you want. You want to pick a strike price that does not have a high likelihood of hitting. And even when it does, you still get paid on both accounts. The premium, as well as that sort of inherent gain from where you bought that asset and where that asset ended up. But definitely let me know what you think. Is this an approach that you've ever taken? And are you excited to finally be that options winner in your friend group? Post in the comments below. We got to hear this out. We got to support the family. And if you haven't done so already, I just want to remind you, make sure you follow me on Twitter at TheBrownGentYT, on Instagram at TheBrownGent. Like and subscribe and share the video. And until next time, I'll see you in the next video. Thanks for watching.